I'm about to break down all of the financial systems that you could ever need to scale your business past $10 million. Right now, we manage 4 8-figure companies' financials, and all of them follow a similar structure. So I'm going to show you how to structure this setup, how to actually implement it in your company, and how to go from low, mid 7 figures to $10 million and above. Okay, so first things first, you need to understand what working capital is. And working capital is your current assets. So the things that are generating you cash flow currently, right? Maybe it's money that's supposed to come in that hasn't come in yet, but it's coming in 14 to 30 days, whatever it is. You need to think about your current assets minus your current liabilities. So that could be interest payments. It can be anything that is taking money out of your bank account every month on a fixed recurring basis. Those are your current liabilities. And that basically gets you something called working capital. So as an investor, right, you need to take on an investor mindset. It's super important to run a business thinking like a strategic, thinking like an executive, somebody who understands that this is just an asset class. There are certain things in the macroeconomic environment that can hurt your business, just like it can hurt any other stock in the stock market. There are just certain things that happen and you're just managing a business. It's an asset class. That's all it is, right? It has a certain type of performance. There's a benchmark. That's all it is. Let's say we take two businesses. Let's say we have both businesses, business A and business B, and they both produce $100,000 a year on X amount of capital that you're using, this working capital, right? What we want to think about is which business is more efficient, which is the better business to own, the one that it takes $500,000 to produce 100K or the one that takes $200,000 to produce 100K. Very simple. We want business B because we understand that if we add more money to the business, it would grow even more. It ideally produce higher returns on capital, working capital, however you want to define it. It's a more capital efficient business. So when we look at businesses from that perspective, we can quickly filter what's good, what's bad, where can things improve, and where are things going wrong, just from looking at that. AR and cash and whatever, and I have $50,000 in liabilities. My net working capital is $50,000. I can only work with $50,000 because the rest is being pulled out every month in the business. That's all it is. So if I have $50,000, these are the typical risk reward metrics that we want to look at when it comes to reinvesting back in our business, right? So if we invest $15,000, we're kind of safe. We're managing our risk appropriately. We're safe with our betting. We're not really trying to go for growth. If we put in $25,000, which is 50%, now we're increasing our risk. A lot of people will say, okay, well, I have this much cash in the bank. Let me put 80% or more into the next initiative that I run. And then this is what happens to their equity. It goes down a lot, right? And when your equity goes down as a business owner, the value of your company goes down and it becomes a lot harder to get back to where you were because you just need to keep making those percent returns, right? So it's very important to consider your working capital and the initiatives that you're taking in your company for growth, for investment, for hiring, and you have to compare it to your working capital. You don't want to overextend yourself, right? How likely is it that you're going to get a certain amount of money in, right? How likely is it that the cash is going to stay in the bank and you don't have to put it for taxes? Are you really sure that that's your cash? Right? There's unearned revenue as well. So it's very important to consider your working capital when you're making growth decisions. And this is why when it comes to hiring or making any investing decisions, we stop thinking about things in terms of dollars and we start thinking about things in terms of time. So if I know that it's going to take a month to onboard an employee, a month before they become productive, and then a month for my next quarterly review to make sure that they're actually hitting KPIs, if I know that an investment is going to be 3 months, then I know that in my working capital, it needs to be greater than, let's say, 2 to 3 times the cost of this employee because they're really only going to start generating profit 1.5 months in. So we want at least 2 to 3 times in terms of months their cost so that we know that we're making a good investment in hiring and staff. So this is what it means, right? When we have danger zone, it means we probably have 4 months of runway because we've grown too much. When we're growing, maybe we have 5 months and maybe we have 6 months, right? The best companies are always profitable, so they theoretically have an infinite runway. Now, don't get me wrong. I have another video coming out where it's like, okay, keep investing, keep taking a net loss, but the unit economics of the gross makes so much sense. And the fact that you can expand so quickly, it makes so much sense that you can keep taking a loss on the net profit and then you keep raising capital because it just makes so much sense, like OpenAI. I promise you, 99% of you watching this are not OpenAI. So you do need to manage your trade-offs and you do need to, be focused on your burn rate and thinking about your profit profitability. You should have a profitable business. Let's go into the importance of budgeting, because if we know that we have a certain amount of working capital and we want to deploy that working capital over 12 months, how are we going to do it? We're going to do it with a budget. Budgeting is the most important part of any business process, in my opinion, because it really sets the groundwork for what you want to get done in the next year, 3 years, 5 years, 10 years. When you're budgeting that far ahead, you're forced to be strategic. You're forced to understand when things are going to go wrong. How much harder do you have to work to make more money so that your business stays afloat so you don't take a loss? What I love to do with my clients is I'll actually undershoot how much money they're going to make just to piss them off, and they make more money. So we'll set a budget and I'll give them very aggressive costs. I'll say like, yeah, you're going to invest in this, you're going to invest in this, you're going to invest in this, you're going to invest in this. And this is how we're going to grow, right? And we're talking with the executives about this. This is how we're going to grow. We need to invest in these staff. We need to take out, this division and put it here. We got to do all this stuff, right? And then what I'll say is, okay, well, our revenue is going to be shit. We're probably not going to make as much as we think we will. And that incentivizes all the managers to start thinking, okay, well, how would I make sure that our NOI on these timeframes, right? Let's say Q1, Q2, Q3, and Q4. How do I make sure that we're actually going to be profitable? Because CFO saying we're going to be losers, and I'm not a loser. I'm a fucking stallion. I'm a charger. I'm going to go and win. Okay, compensation plans. Let's review that. Let's review the KPIs. What can we improve on? How do we make sure that we're hitting this? Because what I've found is with the best executives and managers, they want more people working with them so that we can do more stuff, because they know that the more stuff they can do, the more money the company makes. And they make more money, and people are incentivized in business to make money. It's a win-win-win. The idea is to compress timeframes. So if I'm telling people, oh, we're only going to be profitable in Q3, they'll say, fuck that. I want to be profitable now. I want to win right now. How do we make this happen in Q1? And you see a lot of magic happen. We had a client where they thought they were only going to make, 15 grand in profit at the end of the year for like over the past 6 months. He thought he was going to make 15 grand in profit, right? He ends up making like $250,000 in profit. And then he has a tax issue that we had to solve, all because of a budget, all because we compressed the time frames. We literally made this guy net worth wise a millionaire. He's sitting on a lot of cash, a lot more than he thought he would be had he not started working with us on a budget. It's so important to budget. Even if you're doing it by yourself, just give yourself a realistic expectation of your business. Think about what happened in the past year and think about, okay, what's realistic here? Are these costs going to repeat themselves year over year? Are we going to keep making the same mistakes here? Why were our margins so low? What is the industry benchmark? What am I doing wrong? Doing a budget, the whole exercise of a budget is crucial for that. So the greatest part of having a predetermined budget, it allows you to take bets in real time without waiting on past data that's stale. You don't have to look at your ad account. You don't have to look at anything. All you got to think about is, are you hitting the numbers that the budget was talking about, or are you beating them? And if you're not, when is it time to course correct? When is it time to pivot? It's so important to use the budget as this general guide rail and then forecast in between. We want to see where the stock is going in between. And that means building out, you can have a 13-week cash flow forecast. You can have a 4-week forecast. It depends on the situation of the business. Most businesses I've found only need like 8 weeks, but 13 weeks makes you feel more confident. Fine. That's 3 months, right? That's a quarter. A 13-week cash flow forecast, a rolling one, is pretty good once your business is past like $3 million in revenue. That's when it becomes a lot more handy. Before that, work with a budget, think more qualitatively, imagine more, think about visualizing a little bit more. A 13-week cash flow forecast may or may not really impact your business in the long term, especially, and this is going to be huge in the next video that's coming out next week, especially when it comes to using leverage, because sometimes you need some air to breathe in your business, and trying to make too many decisions and too many moves too quickly without actually seeing the results of your current initiative can be your worst enemy. A lot of initiatives that we take in our businesses take at least a month to start producing results. You're going to work really hard for a month. You're only going to start seeing a result maybe 4 weeks in after you begin it. So pivoting faster is possible once you say, wait a minute, we need a course correct from our original plan in the budget. So it's so important to also have a cash flow forecast if things aren't going right. And this is what we see in all the businesses doing past $10 million. They all have a cash flow forecast. Well, I wouldn't want to say all, but like all the ones that we're involved in, I guarantee you the head of finance, the VP of finance, or financial planning and analysis, FP&A guy, has something where it's like, here's a short forecast of what's going on. The whole point of budgeting, don't forget, is to actually be motivated to go and show up to your business and get punched in the face. We're visualizing the future. We're saying, okay, This is what my personal net worth is going to look like. Here's when I want to take a vacation. The business is going to be fine because we already budgeted to hire these people in this quarter. So I know that by Q3 or Q4, I can go and take a vacation in Mexico, go to the Bahamas, whatever you want to do. But visualizing the future is super powerful because it allows you to have a few weeks, if not months, where you can think about what does your business actually need? What are the biggest constraints in the company? If you made one key hire today in the business, how would your goals 10x, right? How would you 10x your goals just from one key hire, just from one strategic acquisition, just from leveraging the right type of debt? These are huge ways to visualize the future. If I wrote you a $10 million check today, how quickly would you be able to deploy that capital and return it greater than you found it? This is the ultimate question of running a company, and many executives struggle with it because they just simply don't budget and visualize enough. So just by doing this, you'll get to 10 million. I promise you. Then we talk about snapshotting your business. This is when you can actually write the checks, and this is where a cash flow forecast can actually come in handy. If you are super cash crunched and you're running your business to the T, you're on the thinnest margins, that's when it makes sense to run a cash flow forecast. Until you do something like that, and most business owners, unless they're at $3 million and up and they have payroll and they have a lot of other things, they really don't need this, but it is very useful when you do, because if you can plan week by week and you're seriously leveraging yourself to the point where your bank account can be hitting zero, not to mention the fact that we need runway management, which also means treasury management, it can become very useful very quickly. But it is also mainly an emergency measurement, and it's because the CFO or the VP of finance or head of finance or FP&A didn't do a good enough job talking with all the stakeholders in each department to ensure that the business has enough cash to fulfill its needs. You're only really doing a 13-week cash flow for very particular situations, especially when you're trying to monitor a new initiative like hiring a new sales force, trying to understand a new product launch, things like that. In general, I don't really suggest it unless you have a full stack finance team working with you on this and they can do it, and it's just a peace of mind type of thing at the end of the day. By having all of these tools and systems in place automatically running in the back end, it allows all the stakeholders to feel confident in writing more follow-on investments. It allows lenders to want to lend more money to your business. And it allows you as the CEO to have peace of mind and the willingness to go and reinvest. If you have the willingness to say, man, I'm willing to liquidate all my S&P holdings just to push it back into this business because it's the highest ROI I can find right now, that is huge. And it's mainly because you had a budget and then you had a certain amount of cash that was a result of that budget. And the closer they are together, or the more cash you have compared to the budget that you set up at the start of the whole engagement, the better it is for you. Go buy yourself a vacation. Go get yourself something nice if you have so much excess cash, or reinvest it into the next year and try to figure out a way to mitigate the taxes, right? But at the end of the day, all in all, budgeting, cash flow forecasting, sensitivity analysis, all that stuff is going to add $10 million to your business. I promise you, it's just science. It's just how it works. Once you have this, you have a budget, you have an ability to pivot very quickly if things are wrong, and you have a way to measure the ROI of your certain initiatives, you're gonna get to $10 million in revenue. I have no doubts. So if you like this video, please subscribe, reach out to me if you want to talk about your company and how we can help you scale, and I'll see you in the next one.